Good afternoon, everyone, and welcome to another episode of Timeless Wealth with Dirk and Dietz. I got Sean and Amy here today. Today's topic is going to be about on expectations. So from managing investor expectations to expectations about the market, to expectations about portfolio return, to return on investments, all that jazz. And to kick it off right away, I wanted to talk about where we think some expectations come from, or where would expectations come from, right? And Amy can definitely jump in here anytime she wants, but I think some expectations come from family discussions or even from family history, right? So growing up, you're sitting at a dinner table and you hear your uncle or your father talking about historical returns. So those discussions may shape your expectations in the investor world or as investors. Historical returns can also shape expectations, right? So you can say, an investor that's invested in the 70s or the 80s can say, oh, well, back in the 70s, back in the 80s, when we executed this strategy, we got this return on our investments. This was our ROI. So history can obviously shape your expectation. The other thing is entertainment. Personally, I really believe entertainment, movies, shows can heavily condition what people can expect. An example of that is, for instance, the show Wall Street Money Never Dies, or even The Wolf of Wall Street. I'm pretty sure a lot of investors going into the stock market or going into the investment world think that they're going to be the next Wolf of Wall Street, or in our case, Wolf of Bay Street. So those are some really crucial, I'd say, sources of expectations. Another one, and Amy, you can attest to this one, is one way I think people develop expectations of the investment world or of money in general is your question that you once taught me about what initial memory do you have with money, right? So a first interaction or a first integration with money, perhaps it was your first paycheck. Maybe that shaped or conditioned the way you view money and you view investments or view finances. Perhaps a story that you heard around the dinner table about an uncle's big loss in the market. And this last question, I think, is crucial, personally, is because people tend to really latch on to the first memory they have of a certain phenomenon, right? It's almost like the dating culture, right? Like you latch on to that personality that you first dated. You almost latch on to that for quite some time, right? Like it's always in the back of your head when you're meeting people. You always almost compare any person you date to that first individual that you first dated.
Well, and it's a hugely important thing as an advisor that we truly understand the preconceived notions, or you will, or the expectations that clients have when they come to see us, because it really will shape their relationship with money. To your point, like if you think back to about your first experience with money, it could be so different for so many people. I was one of those little saver bees where I had this pink, plastic piggy bank that I stuffed my birthday money and things in. And younger generations might not know this, but you would go to the bank and you'd have this little bank book where they would print your balance. And I was always so proud to go up to the big desk and have it printed and watch that number climb. Yeah. Versus, I have other friends who maybe got an allowance of some sort versus kids who didn't get an allowance. Things like that would really shape how you interact with money going forward.
Yeah. And I think understanding that psychology, or maybe even understanding an individual's first interaction with money, really gives you an insight as to what kind of investor they would be. Are they a saver? Do they want to invest so they can, live a lavish lifestyle? Do they want to invest? But it really gives you an understanding of that lifestyle that they're trying to attain, and what kind of a client or what kind of investor they would be.
Well, and I think, sorry, that's critical, right? Mm-hmm. And if you look at what Amy described in her upbringing, well, that existed for folks that were born in the Depression. You look at people that are in their 80s and in their 90s, God bless them. I mean, the greatest generation.
The greatest generation?
They fought in World War II and preserved our freedom and did all, their formative years were in a very, let's say, dry environment, mm-hmm. Especially in the United States where there was drought and so on and so forth, and in the prairies. And then they went into, and in Canada, it was just a stressful time in terms of like a huge unemployment, high interest rates. Mm-hmm. Back then, governments really didn't understand how to manage the economy like they can today and manage mm-hmm. the economic cycle. Mm-hmm. And then they went into full-blown World War II.
Oh, yeah.
And then they came out of that and went into the Korean War and so on and so forth. So, and that really formed, if you talk to somebody who's in their 80s about money, mm-hmm. they have a very, very different view than someone who was born in the 70s or someone that was born in the 80s.
Right.
Now, me, I was born in the 70s, early 70s. I'm dating myself, but I just remember in my formative years that money was very expensive.
Yeah.
Mortgage rates were between 14 and 18%. And
you remember that? I know they were that high. You remember that?
I remember that very much so, because when I was younger,
because for me, as long as I know, mortgage rates have been low. Like
my
I'm a 1990s child, so like by the time I knew what interest rates are, I think they were much lower than that.
Yeah, when I was younger, I mean, my nickname was Alex P. Keaton, and for those of my age, they would know from Family Ties, Alex P. Keaton was very much into politics and economics and so on and so forth. So I actually caught on to the value of money from let's say an economic standpoint at a relatively early age. Probably when I was 13, 14, I started reading the business page of the Globe and Mail religiously every day. So I really understood that when my parents went to get a mortgage, they were not really gaining ground on the principal of their property because rates were so high. You're just lucky. You're happy to just make the payment and cover the interest cost. And, then I learned very quickly through, my family background that, my father was a teacher, then a principal, then he was a union head for the Ontario Teachers Union and so forth. And my mother was a kindergarten teacher. But my father's brothers were entrepreneurs. And I knew very quickly, the ups and downs of the entrepreneurial world, where ultimately my two uncles did very, very well, but there were cycles where they weren't doing very well. My father always had a stable paycheck, but in a rising cost environment, it really crested their thinking in terms of what they could spend money on and what they couldn't. And it's somewhat reminiscent, where we are today. It's similar. It's not nearly as bad.
Yeah.
But we're in that kind of environment today. And it's starting.
But if you just unpack what Sean said there, it's not just your first experience, but look at how it ties back to family history, right? So if I start to unpack, why was I such a saver bee? Well, I looked at what my family went through. My grandfather, used to tell the story of how he got their first home. They couldn't go into the bank and they wouldn't qualify for a mortgage. They had to get the local veterinarian lent them some money, and it was an on the side mortgage, and they built their own home. They got boards, they pulled out nails, and they built their own house from scratch. And so having that instilled in that value of money was instilled for generations. And it can go both ways, right? So I took the way where I was going to be a saver and I understood the risks involved of potentially not having money. But then you can see other people where it might go the opposite way. They watch their parents maybe invest in a more risky type investment and see how it doesn't work. They might become, not the same as their parents. They might become complete opposite because they see what doesn't work.
More savers than risk takers.
But it all kind of goes back. It links generations to generations, how it does pass along. So understanding, and we talk to our clients about this, is talking to their children. What stories and what things are you passing on to the next generation? So for our clients, they tend to be quite successful and they've amassed a certain amount of wealth. It's not so much to say it's in my will, they get the money. It's how do you pass on that legacy of how you've gotten to that point? What were the best practices?
So how do you pass on the rationale of accumulating and amassing?
How do you instill those habits?
It's also built under the guise of that money. Money for many people that are our age or older is not viewed as a good thing or a beneficial thing, or they're very proud of owning it. I mean, no one who's generationally wealthy ever goes like, "Well, I'm upset about it." They're not. But if you look at, for instance, you mentioned entertainment. You brought up, Wall Street, Money Never Sleeps.
Yeah.
Which was the far inferior byproduct of Wall Street, the real movie.
Yeah.
With Gordon Gekko, Michael Douglas winning the Academy Award.
Yeah.
With the famous speech, "Greed is good."
Yeah.
Right? And that's where we were conditioned, where we saw anyone who's rich was a gecko who was out to screw the average person to make themselves richer. And so at the end of the day, and there's a number of different movies, like Wolf of Wall Street is a derivative of that.
Yeah.
True story, by the way. Jordan Belfort is his name. And,
I love the movie, and the story is amazing.
Well, to hear him actually talk about it in first person,
I follow him on TikTok.
Like you can't help but like the guy. In spite of what he did was absolutely wrong. But man, he's paying it all back, by the way.
Yeah.
See something else. But and if you have John Madden, or what is it, Madden Shoes? Yeah, that's born of that whole thing. Anyways, the point is that conditions you for how you communicate to your children, to your grandchildren about finances. Well,
and that's what I wanted to talk to you guys about. Like, I wanted to talk to you guys about and ask you questions and really drill out some information from you guys in terms of client expectations. Like, I'm sure as financial advisors, you probably call a client, suppose it's a brand new client, right? Like a prospect. One of the first, you introduce yourself, you explain what you do, blah, 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 blah. One of the first questions they're going to ask you is right off the bat, okay, what's your ROI? Mm-hmm. Right? So there's obviously an underlying bias there, right? And when they mean that ROI, they're specifically talking about hard percentage ROIs, mm-hmm. right? But, I think in my opinion, that cannot be the only measure for a return on a portfolio, right? So what can you guys tell me about that? In terms of managing a client's expectations, where does he or she only expect absolute percentage returns, and are those returns, for example, is a higher return always worth the higher risk that comes with it, mm-hmm. right?
And it's a good question. So when clients immediately, or somebody you're talking to says, well, what rate of return can you get me? We need to back it up a step, because we got to understand what your risk tolerance is, right? We all talk about that, and there's a form and a little checklist that we go through, but really understanding how much money do you need to fund your lifestyle?
Yeah.
Let's start there and figure out what you need. Because if, say, for example, we do a financial plan, it turns out you need a 20% rate of return to achieve your goals versus somebody else only needs a 4% rate of return. Well, those are two totally different ways to engage the market. One, on the one end of the spectrum, you're going to have to be way more aggressive in the market and taking on way more risk, versus somebody who needs a lower rate of return. They don't have to be as risky. So understanding what their personal benchmark is versus how the TSX do, how the NASDAQ do, that's interesting.
Yeah, I mean these are just indices at the end of the day.
They're indices, yeah. But what's more interesting to us is what is their number? Right? What is your number to achieve whatever it is that your goals are?
Because at the end of the day, the market is going to do what the market's going to do. Yeah. And when we talk about market, traditionally we think of indices. Mm-hmm. But there's a vast array of markets out there: private credit, fixed income, there's real estate, there's mm-hmm. air rights. There's a market for everything in the world. Corn, right? Mm-hmm.
So did you say corn?
Corn. There's a market for corn. It's actually a heavily traded market that's being disrupted by the Russian-Ukrainian war. So there's a whole bunch of interrelation in terms of all these markets. And at the end of the day, they're going to return what they're going to return given the macro forces that are impeding upon them, right? And then you have, company-specific things, or maybe, credit-specific things that maybe adjust the rate of return here and there. At the end of the day, it doesn't matter. Because for each rate of return, for each asset class you invest in, yes, there's an expected rate of return with a standard deviation. Like you asked about, how do you measure ROI? There's a ton of ways to measure return on investment, right? There's standard deviation, Sharpe ratio, information ratio. I can go on and on and on. So at the end of the day, that'll set a person's head to spin. I think the average person wakes up and says, okay, what do I need? How do I need it? And what can I accept and sleep well at night to get what I need to live forever? And then hopefully have intergenerational wealth that you can transfer to the next person.
Right. So if I understand correctly, like sometimes the extra risk, for a greater return, although, and Amy, I've spoken to you about this before. Although, for example, a 20%, or let's just be a little bit more realistic, maybe a 15% return is better than a 10% return. But that difference in the 5%, will it actually make a difference in that person's lifestyle, mm-hmm. right? Is it worth the risk?
Yeah.
Is it worth the risk to take that extra 5%? When it's going to make no change in in your lifestyle.
If you're not going to change your lifestyle, then taking on that additional risk, you have to ask your question: what if it doesn't work out? What if you go through a period where things are very disrupted and difficult, and then you can't meet your goal because you took on too much risk? So really saying to yourself, what is it realistically that I am trying to achieve, and what are my goals, and what is my personal benchmark or my personal rate of return, and target that.
Yeah, and I think, I don't know, Sean, maybe you can agree with me here. I think that sounds a little bit more, I don't want to say realistic, but a little bit more centric to the individual, where instead of taking like, for example, the TSX or the S&P or the NASDAQ as a benchmark, or as the only benchmark, I think taking that personalized benchmark, like, are you living up to the lifestyle or up to the standard that you want to live? Mm-hmm. I think that is a more viable benchmark to measure returns for somebody, right? Mm-hmm. Like if they're not going to live any more extravagantly, why put them, whether from the advisor to the client or even the client, him or herself, why expose yourself to that extra risk when it's going to be the same thing? Like, I think greed plays a role here, and I think behavior and definitely plays a role here, right? Where people just want to amass as much as possible.
Yeah. So let me suggest this. So Warren Buffett always talked about, when you look at the Berkshire Hathaway portfolio, he always said, look, at the end of the day, him and Charlie Munger expect, and the people that work with him expect that portfolio to generate market returns. I put quotations around that. Plus or minus 1 or 2%, year in, year out, year in, year out. But what Warren Buffett always said that made them special is they're always seeking what they call supernormal returns, where you find an asset that's so undervalued that the margin of safety is such that if you invest in it today, you can get compound returns of 20, 30, 40% per year. But he stresses they're very rare and very hard to find. And there's risk in them, right? So Ray Dalio supported that by saying, at the end of the day, the risk of seeking supernormal returns is the risk you might not get them.
Is what, sorry?
The risk you might not achieve them. Sorry. Yeah. And so at the end of the day, and there's a corresponding downside risk to going after supernormal returns. So as an individual, where you've reached a certain position in life or a situation in life financially, you have to ask the question, let's say my run rate is a 6 to 7% compound rate of return, which is a very powerful compounding number on your asset base. You can imagine if you're 50 years old and you're worth $5 million, you compound at 7% per year. I don't have a calculator in front of me, but by the time you're 90, you're probably going to be worth $35, $40 million. Something to that magnitude. I'd have to do the math, but it's something like that. However, if you want to, and your downside risk is if you go for like a 5 to 7% compound rate of return and you make a mistake, you might only get 3, but you're not wiped out. Achieving maybe a 12% rate of return and shifting your whole asset mix into classes that over time give you that rate of return, your downside might be a -4 or a -5.
Yeah.
And a loss hurts you more than a gain helps you. And so at the end of the day, what happens is, in a long-winded way, is that, getting that extra 2 or 3% in the short run or over 5 years might not make a meaningful difference in your lifestyle in terms of you buying more. Because once you reach a certain level, people tend to not buy more.
Yeah.
You just live your life. Yeah. But if you were to lose a compound 3 or 4% over that 5-year basis because you misallocated your risk, that changes your lifestyle. It hurts you. And so at some point you go, it's not worth it, or it shouldn't be worth it.
Well, it's very psychologically painful too.
Yeah, it is. And I think the other thing in today's world that is different, especially with social media, right? Our expectations are a lot different than they used to be, right? So I was at a conference the other week and they said, what was the golden era? If you think back, what was the golden era? And everybody came to the realization that when we talk about golden era, it was the 50s. The 50s seemed like the golden era. And then we started to unpack, well, why was it the golden era? And it was the income, everybody was about the same, right? Their house sizes were about the same. Their incomes were about the same. Their cars were all very similar in terms of value. They all went on their standard trips. Everyone was more in line in terms of their incomes, and everything was more aligned. But if you look at today, where the income gap's getting wider and wider, expectations have become more wide and wider, right? So it's
100%.
You're watching somebody on, Facebook or Instagram, and you're seeing the highlights of their life, and then it's, well, how do I get that? And I need that. And it's really, do you need that? And let's really get back to your own personal self. But it really is having an overall effect. We see it with our clients, right? It's how do we get our kids the house, and then how do we get our kids the cottage, and they got to keep up with all these different things that are going on. It becomes a lot more pressure, but the question is, are they happier?
And we could do a whole episode on social media. Yeah, I mean that's a whole conversation in and of itself.
I mean, and I think one thing about social media is it's heavily filtered. Like, most of the travel pictures that you see, people don't really travel that much, and obviously it's heavily filtered, and it's also a huge determinant of what you believe in terms of returns and stuff. Like, there's no doubt, it really conditions what you believe, and it really affects what you believe in.
But the media doesn't focus on, like, you never see, like, you know.
But here, I wanted to say, Sean, one more thing. Sorry to interrupt you, but I did want to say, like, you were talking about 5 to 7 or finding that, what did you call it again? Finding that one that's going to, like, really make you rich?
Supernormal returns.
Supernormal returns. I think the reason, and I'll tell you, I was guilty of this, like, I was a victim to this, is because you do hear stories about people making supernormal returns. So it's like, man, I want my share of the pie, right?
Yeah.
But I think our problem is that when people, just like social media, when they do have supernormal returns, they'll post on it, they'll post about it on Facebook, on Instagram, on TikTok, but people usually, when they suffer huge losses, they don't post
talk
it.
about that.
It's like the whole Bitcoin thing. Like, sure, when Bitcoin exploded to nearly 80,000 USD, there was a ton of people that made a huge amount of money off of Bitcoin. But I think, personally, I believe that was just the tip of the iceberg. I think a lot of people, as Bitcoin was growing, because it grew, and then it crashed after, I think a lot of people lost a lot of money. And I think the losers were much more than the gainers and the people who actually amassed the wealth.
Well, look, and that's the thing, right? That's why investing is so much behavioral, right?
Yeah.
Like, look, at the end of the day, if you study daily returns on the S&P 500, and this would apply to the S&P TSX, the German DAX, or pick a market, the Nikkei, whatever. But if you study market returns over longer periods of time, the simple reality is the market is up roughly 50.5% of the time on a daily basis, and it's down roughly 49.5% of the time. It's roughly that. But you aggregate that over a period of time, like, for instance, over a month, well, basically 52.5% of the time months are up, and the remainder is months are down.
Yeah.
But you aggregate that over a period of 3 years, it turns out that, most rolling 3-year periods, probably 60% of the time, 65% of the time, rolling 3-year periods are up.
So, yeah.
Then based on that, on a rolling period over 5 years, it's almost always up. And over a decade, it's 100% up every time on a rolling basis, the S&P 500. But watching it day to day, it's like basically drip torture.
Yeah.
Right?
Especially nowadays. Like,
and then you get influenced.
We're in June 2022, and May was terrible, and June doesn't look like it's going to be any better.
And 10 years from now, I hate to say it, because there's a lot of real awful things going on, it won't matter.
Yeah.
It just won't. People will be, if they behave properly, people will be wealthier than they've ever been, just like time eternal.
Well, a good example of that is we often will hear clients say, we always make money in real estate. We always make money in real estate.
Funny, I was just about to ask you.
But if you think...
Isn't it good if I just put in real estate?
But if you think about it, it's investing in real estate, and we won't disagree, it's a great asset class. It's not the only asset class, but it's a good asset class. But your house isn't flashing a price every second of the day, right? So it's a lot easier to think long term because you're not seeing that value go up and down. So you're not behaving or reacting to market behavior. Well,
the other thing too, Amy, is a lot of people have their head in the clouds when it comes to real estate.
It's true.
They do. They don't fully cost their investment in real estate. Not even close.
They don't fully what, sorry?
Cost it.
Oh, cost it. Okay.
So let me ask you, when you own real estate, you just buy real estate and just, that's it?
No, you also have like taxes, you also have repairs, any maintenance on the house.
Legal costs, taxes.
You got to mow the lawn, you got to fix the plumbing, you got to pay taxes, all that stuff, right? Those are all sunk costs. That should be costed in against the investment. People don't. They go, oh, I bought this property for X 25 years ago. I sold it for Y. And what a great investment. Well, yes, it is, right? But like any investment, including a business for that matter, you got to invest money into it to make money.
And a lot of time. And in real estate, I think what a lot of people forget is you also have to find decent tenants to actually live in that house, right?
Yeah.
Like, I know stories where, tenants just absolutely trash the house.
Yeah, I've lived that dream.
Yeah.
Oh, you have?
Yeah. So
like one of my buddies in Cold Lake in Alberta rented a house, and when he told them that, he gave them even 4 months up front, like, I need the house after 4 months. He went in there, the drywalls were completely torn off.
Yeah.
And it was terrible. I'm like, what?
But here's the thing, Jalal, and this is important about your personal benchmark. I think first off, there's no dispute that if you allow time to work on your behalf, you'll be successful. And if you're patient in investing, you'll be successful. The more short-term you're thinking, the more you're prone to a recency bias, you're prone to a mistake, and that'll hurt you.
Yeah. All right. And the last thing I wanted to talking about expectations and compounding and everything, one last thing I wanted to touch upon is, and maybe you guys can shed light on this. I think if a goal is to amass wealth, I think a lot of families or a lot of parents also forget that even if one of your main goals is to pass on a good amount of wealth to your kids, I think they're forgetting to have those conversations with their children, right? Obviously, we've heard many times where generation one, for example, the first generation that amassed the wealth, and the second generation either blew it or they were just, you can say, custodians of of the wealth. I think can you guys touch upon the types of conversations, or what kinds of conversations parents should have with their children in order to actually preserve that family wealth from one generation to the next, whether in the context of business or just in the context of personal wealth?
Well, first I would say a lot of people, business owners included, and our clients, some of them don't have wills. Not only no wills, no powers of attorney, but that's only one part of the equation. That's only like if you're passing on, the money goes to the next one. Those conversations about those documents, about how their philosophy around money, their expectation. We've often seen clients where all of a sudden they inherit an amount, and it'll go one of two ways. They're either completely frozen because they don't know what their parents would have wanted them to do, and there's a whole lot of guilt associated with that.
Yeah.
Or we'll see they're not sure what to do with it, and they just kind of go out and it gets spent very, very quickly, and it's the wealth disappears very, very quickly.
So they don't pass down like the rationale or the understanding of how to manage the money or what to even do with the money.
So it's having those kind of conversations, which again, people don't want to talk about their death or getting older, and it's one of those things like we'll do it later, but it's so important in terms of preserving wealth. Otherwise, it's that point where it does switch, it can be a huge wealth destructor.
To be clear,
yep.
When someone inherits money of any magnitude, it's a binary outcome. It either serves for massive good within the family that inherits it, or it can rip them apart. And there's no middle ground. None. So these conversations that you have to have with your beneficiaries, you have to impart all these things about what it took to earn it, the values behind it, how you want the people that are going to inherit your money to enjoy it and spend it and support them and train them. Because at the end of the day, depending on the nature of success of your children or your beneficiaries. And let's face it, there could be a wide disparity in terms of how children have done. And by the way, we love them all, right? My children, I have a son who's special needs. He's going to have a very different life trajectory than my daughter. Plain and simple. They both need to understand that once my wife and I are no longer here, the nature of how they're going to inherit their money and how it came to be and so on and so forth. Because ultimately, it's the values that you impart on them that's going to help them as they go forward.
And it's so important. Like one of the things we're so passionate about is we don't want any of our clients to die intestate, meaning you don't have a will. We don't want any of our clients to not have powers of attorney of finance or health.
Anybody to
well,
die
imagine
intestate.
Being in the hospital, and we've seen this firsthand.
You're
in the hospital.
Do you have any examples of that?
Clients in the hospital hasn't prepared. They're literally laying in the hospital with lawyers by their side, trying to organize things in their final moments. That's if they get that opportunity. It happens so fast they don't have that opportunity.
The way to describe
when
it,
you're on your deathbed, the last thing you want to enjoy the last few moments with your loved ones. I think the last thing you want to think about is lawyers and writing up legal terminology
but the speed at which it turns, it is that fast. And the way I'd akin this to or liken this to, picture yourself drinking out of a garden hose one nice summer day. You're drinking out of garden hose, and then in an instant it turns into you're drinking out of a fire hose.
Jeez,
that's what it's like, and you cannot turn it off. Once it goes, it's going. You can't go back in time.
Well, and also the reminder of, yes, when you pass on, but also people are living a lot longer today, right? So there's more of a chance where you might become incapacitated, meaning you just can't make the decisions financially for yourself around your health or around your investments. All of a sudden, and usually it might be the children, they're thrown into, here's mom and dad's portfolio and
Well, let me
figure it
add
out.
one more on that. So in a lot of cases, families have 2 children. That's a little bit of an easier math equation to manage in terms of, conveying values and how the money's going to transition. But I know a lot of families that have 3, 4, 5 kids.
Yeah. I'm from a family of 5 children. So,
Okay. Yeah. So you've taken stats and, over your time. I know Amy has. I'm very bad at it, but I understand the concept of a permutation and a combination. The more people you put into the mix, the more variability of outcomes that can occur.
100%.
And a lot of people expect that when they pass on, Bobby, Timmy, Sally, Jimmy, and Ron are all going to get along as it relates to the estate happening.
Not happening.
That doesn't happen because of the whole concept of, chaos, right? And
especially when money's put into the situation.
Especially when money, right? So at the end of the day, the more children you have, it makes it just so much more imperative to make sure that the conversations
I think that pre-planning and really pre-planning, whether it's business or even personal wealth transitions, is extremely crucial.
Yeah.
I think, and you can attest to this, but I think it's really important to start the conversation early because, as you said, you never know, obviously, you never know when anyone's going to die, or even just randomly become incapacitated. And you can't structure whoever is going to be the beneficiary or whoever are going to be the beneficiaries. You can't structure it in a way you want if you're incapacitated, right? So I think it's the earlier the better, and updating it, even if you do it 20 years before you retire, 15 years out of retire, there's no wrong with updating it once a year, once every couple of years. Right?
So I'm sitting here, I'm listening to this podcast, and I realize, okay, my wife and I, we have 5 kids. I'm worth whatever I'm worth.
Yeah.
And I'm at position 0. Like, let's say question 1, part A. What's the first step that I take?
Talk to your advisor. Sit down and
Which advisor do I talk to?
In terms of?
Just moving forward, period, on this.
So where I think this is different is our clients come to us. We're financial advisors, but oftentimes lawyers are more transactional. Your accountants are more transactional. We're looking at all the different moving pieces. And to circle it back into expectations, is this end of life or healthcare, perspective is lining up all of those expectations.
That's the key right there. That, you want to talk to us. We can start the conversation. We can help, not shape your thinking. We want to listen to you. We want to help guide you, and we want to help reinforce the importance of it and help take you through the steps.
Yeah.
It's not an easy process. It's easier than people think. But you have to go through the steps.
There's just so many things that are linked. And so you just want to align the expectations of all the different moving parts so that you've got a plan in place.
It takes some time, but once you're through it, you're going to feel pretty good you did it.
Yeah. Yeah.
Well, thanks, guys. I just wanted to conclude then. I think if there's one thing I want our listeners to get out of this podcast is that while absolute percentage and absolute returns are crucial, I think the returns being measured against your lifestyle, I think those are either as important or even a little bit more important. I'll say again, and correct me if I'm wrong, but I think sometimes that extra percentage that you're going to get out of the extra exposure of risk is just not worth it at the end in comparison to your to the lifestyle. Like, is it really going to change your lifestyle that much, right? If you're buying, like, for example, that extra 5%, if you have a $500,000 yacht, that extra 5%, is it going to give you like that $5 million yacht? It's not. You're still going to probably stay with the same yacht.
I got a funny story.
Is it worth that extra?
I don't know.
I got a short funny story to say, because I was driving with my daughter to the grocery store the other day.
Yeah.
And, we're pulling on into the, the street intersection, and there's this Lamborghini Countach.
Oh, one of my favorite Lamborghinis, by the way.
And I looked at that thing and I went, what an annoying car.
What?
And then I saw it drive off, the stoplight turned green and made this annoying noise.
Yeah.
And it buzzed right. And I'm like, what? It looked uncomfortable. It looked stupid. I could win $200 million. I'm never buying one of those stupid things. Mm-hmm. So that's my perspective, right? Yeah. Now, when I was your age, Jalal, I'd be like, cool car, man. But now I'm in my pickup truck and I'm like, that thing's a jerk. So that, if I got that extra return, it ain't going to a Lamborghini.
No, I get it. It's just, The Countach is one of my favorite. That's why it was funny. You know? But no, I can see that. I can see when I'm 60 years old, Sean, I think I'll think like that. I'm kidding.
Touche. When I'm 60, I'll think that way too.
All right, guys. Well, thanks a lot for your inputs. And anything else you guys want to add? Or
nope. See you next time.
Well, thanks, listeners, and hopefully you guys tune in for the next episode. Ciao.